Hi, everybody. I'm here today with Greg Wachter, Vice President of Risk Management at Barnum Financial Group. Greg, thanks for making some time for us today. We're going to talk a little bit about the different types of insurances. So, Greg, let's start off with term insurance. What exactly is the difference between term and permanent insurance?
Yeah, great question. And it's a question we get pretty frequently. So term insurance is like renting a house. You get the coverage for a specified amount of time, 10 years, 15, 20, 30 years. And at the end of that duration, there's nothing left. So just like renting an apartment, you move in, you live there for 10 years. When you move out, you don't get anything back. You don't own anything. Same thing as your term insurance. Now, with term insurance, you can get a lot of coverage for a relatively small premium. And one of the great features of it is that in the future, if cash flow or budget changes, you're able to convert that into a permanent policy. So you have coverage even after the term expires.
So that conversion feature certainly sounds like it's valuable.
Yeah.
Let's talk about permanent insurance. What are the different types of permanent insurance that exist?
Yeah, so there's a bunch of different types of permanent insurance, really broken down into whole life and universal life. When we talk about whole life, it's like buying a home, just the opposite of term insurance. So when you take out a whole life policy, just like buying a home, you have a mortgage stated for 30 years, you have a premium duration that's set from the beginning. So it could be to age 65, it could be for 20 years. The longer the duration of pay, the longer it takes to build equity, but the lower the annual premium is over each year. The shorter you make those premium durations, get just like taking a 30-year mortgage into a 15-year mortgage, you'll pay a lot more on an annual basis, but you grow equity a lot faster and you're paid up in a lot sooner. So, and at the end of that payment period, you don't have to give the policy back. Now you own the policy and can access all the equity inside of it as well.
All right, Greg, so what's the best approach for deciding what the type of structure, what type of policy is best for each client?
Yeah, a lot of clients come into calls asking, what's best? And in reality, the best is dependent on the situation at hand. Term, whole life, permanent insurance, it's not mutually exclusive. Many times, almost every time, it's a combination of both. So most people have needs that decrease over time, like a mortgage payment or kids going to college, and we could cover that bigger, larger need with a term policy for a lower cost. And then a portion of that coverage will either be permanent up front or over time turn into permanent. So again, when the term does expire, you do have something in place that'll be with you forever. Whether that's for legacy planning, estate planning, long-term care planning, many different reasons to have it, but most of the time it's a combination of both, really dependent on cash flow and overall comfort level with the budget and what we're looking to accomplish.
So what are your thoughts on variable life insurance policies, also known as VULs?
VULs are great policies, great products, and they're nice because they're very flexible. They're variable in every sense. They could have a variable death benefit, go up and down depending on the market, variable cash value inside of the policy. Everything, all the money inside is invested into different mutual funds and ETFs that you have access to choose from, and the premium as well. Depending on how you want to use it, you could put in extra money to really boost that cash value and access to it, or you could more control it and lower that premium in certain years when your cash flow is not as good. So main difference between variable and whole life is variable policies are invested into the stock market and are based on the return that you choose inside. Whole life grows on a guaranteed interest and dividends that are paid by the company. So it's what we refer to as a non-market correlated asset, where again, variable, just the opposite, invested into different mutual funds, ETFs, and really the overall performance depends on those underlying investments that you choose.
So would you say that whole life is a little bit more conservative than VULs?
Much more conservative, yeah. It's something that when we show you a projection on a whole life policy, not saying you'll guaranteed to have the exact amount of money that we show, but there's a very low variance of outcomes. My personal opinion is I take risk in a lot of places. My 401k, my Roth, my investment account, and I don't want to take as much risk inside of my life insurance. I want to know my insurance will be there in the future and have more predictability around it. Other people feel completely different. They want to maintain that same risk level as they have in their other investments. Might be diversified in different funds and so on, but want to have that appreciation upside and are willing to take those downswings if they do go that route. But ultimately, it comes down to the risk tolerance of the client that we're dealing with and how much risk they want to take towards this specific section of their financial plan.
That's a really helpful perspective, Greg. I appreciate your time today. It's always a pleasure to sit down with you and have a chance to have these types of conversations. If there are any clients out there that have any questions and want to schedule any time, Greg and I are always happy to make time to go through each of these opportunities and situations and explain to you how it all works so that you have a personalized view on this. So feel free to reach out at hankplyler.com. Thanks so much, Greg.
You're welcome, Hank. Thanks for having me.